Welcome, ladies and gentlemen, to another edition of Accounting 101 Made Simple by Jay Ham. Today's topics discuss lesson number 1. We'll cover the 7 steps of basic accounting, and we'll also cover understanding the fundamental accounting equation and its components. The 7 basic steps of accounting. In the 7 basic steps of accounting, we first start off with step 1, which is identify all accounting transactions. And you do that through examination of source documents such as vendor invoices, sales invoice, purchase orders, contracts, things of that nature. We'll get into that in a later video lesson. Then step 2, we will post those accounting transactions to what is called a general journal. And that's just a summary of all of your accounting transactions for a particular accounting period. Step 3 would be to post the general journal amounts to what is called a general ledger account, and that's a summary account of all of your different financial statement account balances. And then you have step 4, which is post general ledger totals to what is called a trial balance, and that's going to serve as the formation of your financial statements. Step 5 would be to tweak that adjusted trial balance by posting adjusted and closing entries to come up with what is called an adjusted trial balance. So your adjusted trial balance in step 5 is very critical because it serves as the basis for generating your financial statements. Always remember that the adjusted trial balance is the foundation on which your financial statements stand. And your financial statements are your balance sheet and your income statement. You have statement of cash flows, but we'll cover that in a more advanced accounting topic. I want you to get comfortable with the basic set of financial statements, which is the balance sheet and the income statement. So step 6 would be to post the adjusted trial balance totals to the balance sheet. And step 7 would be to post the adjusted trial balance totals to the income statement. That might sound like the same thing, but you have to remember that the adjusted trial balance that you generated in step 5 contains P&L or income statement financial statement line items, and it contains balance sheet financial statement line items. So you're pulling from the same source, which is the adjusted trial balance, to come up with your balance sheet in step 6 and your income statement in step 7. Now we'll move on to the fundamental accounting equation. Another word for the fundamental accounting equation is the balance sheet equation. So just be cognizant of this because a lot of times that'll come up in accounting exams. As you do your accounting 101 and your managerial accounting and you're taking accounting exams, you're going to see questions that refer to the balance sheet equation. Just know that when they're talking about the balance sheet equation, they're talking about the fundamental accounting equation. The two phrases are interchangeable. They mean the same thing, in other words. So what is the fundamental accounting equation? It's simply assets minus liabilities equals owner's equity. What you have in money, what you pay out in bills, is what you have left over in owner's equity. So the fundamental accounting equation can be expressed in various ways. So we'll go over 3 ways in which it can be expressed differently. It can be expressed as assets assets minus liabilities equals owner's equity. It could be expressed as assets equals liabilities plus owner's equity, or it could be expressed as owner's equity equals assets minus liabilities. The thing to keep in mind here is to always remember that the assets minus liabilities always equals owner's equity, and that whatever's on the right side of the equal sign must be what's equal to the left side of the equal sign. So let's take the first equation for an example. You have assets of $100 minus liabilities of $60 equals owner's equity of $40. Look at the equal sign. Look at the equal sign on the second row. What's to the right of the equal sign? $40. What's to the left of that equal sign? 100 minus 60. What is 100 minus 60? It's 40. So what you're saying is 40 equals 40. Let's go on to the next equation. Assets of 100 equals liabilities of 60 plus owner's equity of 40. Look at the right side. What's on the right side of that equation? 60 plus 40, which is $100. What's on the left side of the equation? $100. In other words, $100 equals $100. Let's go on to the third one. Owner's equity of 40 is equal to assets of 100 minus liabilities of 60. What's on the right side of the equal sign? $100 minus $60. Well, what's $100 minus $60? It's $40. And what's on the left side of the equal sign? Owner's equity of $40. So in other words, you're saying $40 is equal to $40. That's what you have to keep in mind when you come across the fundamental accounting equation. So let's go over the different components of the fundamental accounting equation, which are assets, liabilities, and owner's equity. So we'll start off with assets. So what is an asset? An asset is a resource with economic value that a person, company, or country owns or controls with the expectation that it will provide future economic benefits. Now, the reason why I highlighted and underlined the phrase future economic benefit, because it comes up on accounting exams a lot. It will say, what are assets? Is it a true statement that assets are provide future economic benefits, true or false? And the answer would be true, yes, because assets provide future economic benefits that you own or the company owns. Examples of assets are as follows: cash, like cash you have in a checking account, cash you have in a savings account, that's cash. Even cash that you have like in a money market account or a marketable securities account would be considered cash. You have inventory, which is basically your product or your merchandise that you sell for your customers in exchange for cash. That's why it is an asset, because inventory can be converted into cash. Accounts receivable, again, the money that you owe someone else. So say if you took that inventory that we just talked about and you sold it to a particular customer, but that customer did not have the money to pay you for that inventory, he would then owe you that money, and you would set up an accounts receivable or an account or a credit with him, an accounts receivable where he will owe you that money and he would have to pay you cash to satisfy his liability to you. So basically, accounts receivable is another asset that is readily converted into cash. Equipment, cars, vans, trucks, furniture, buildings, and other property, those are all examples of assets. Assets put money into your pocket. It's contrary to liabilities, which take money out of your pocket. We'll discuss that in the next slide. But assets are classified as either current or non-current. And depending on whether they're classified as current and non-current depends on how soon you anticipate liquidating that asset into cash. So if you anticipate liquidating that asset into cash within a 12-month period, which is one accounting period or one calendar year, you would classify that asset as current. If you anticipated on liquidating that asset in a time period greater than 12 months or one accounting period or 1 year, you would classify that asset as non-current or long-term. So moving on to liabilities. What is a liability? Well, a liability is something a person or company owes to someone else, usually the sum of money. It's the opposite of assets, right? It is a sacrifice of your assets or future economic benefits. The reason why I put quotation marks around the word sacrifice, because a lot of times that would come up on accounting examinations. What are liabilities? Liabilities is a sacrifice of your future economic benefits or assets. Some examples of liabilities would include accounts payable, which is the money that you owe someone else. So it's opposite of accounts receivable. Accounts receivable is the money that someone owes you. Accounts payable is the amount of money that you owe someone else. And loans that you take out, mortgages that you take out against property, those are all forms of liabilities. Unearned revenue. Well, what is unearned revenue, Professor John? Well, unearned revenue is money that you receive from a customer for goods that you or product that you haven't shipped to that customer, or for services that you haven't rendered to that customer. So say if my neighbor across the street gave me $1,000 to mow his lawn, and I didn't mow his lawn yet, I treat that $100 as unearned revenue until I mow his lawn. So I owe him the service of mowing that lawn, and since I owe him that service, it's a liability. And last, we have accrued expenses. And accrued expenses is an estimation of a liability. Just keep that in mind, that accrued expenses is an estimation of a liability. Accounts payable is where you know the exact amount of the liability, and accrued expenses is where you're making an estimation, and then when the actual bill comes in, you then make the adjustments to reflect the actual amount of the money that you owe for the liability. So liabilities take money out of your pocket. It is contrary to assets that put money into your pocket. Liabilities are also, just like assets, classified as current and non-current, and it's the same rationale as liability as asset classification rather, and that is how soon do you anticipate paying off that liability. So you have a bill in, and if you anticipate paying that bill off within a 12-month period, then you would classify that as a current liability. If you say, I don't have enough money, it doesn't look like we're going to be able to pay this thing off within a 12-month period, then you have to classify that liability as a non-current liability on the balance sheet. That's the same. It works the same with assets as well. So same rationale. Owner's equity, or simply put, equity. Owner's equity or equity is what is left over in your company after you have sold all your assets for cash and then paid off all of your liabilities. So remember that fundamental accounting equation, or that balance sheet equation. Assets minus liabilities equals owner's equity, what you have left over. So some examples of owner's equity are common stock. And common stocks is shares of your company that you sell to others. And those others would be considered shareholders or stockholders. So you sell a piece of your company to raise money to purchase a piece of equipment or a factory that's going to significantly generate your income, which is going to significantly increase your bottom line. So that's how that would work. Then you have paid in capital or additional paid in capital. And additional paid in capital or paid in capital is the money that you paid over the par value of the stock. So say if you have a stock that's $10 par value, but you sold it to a shareholder for $100. You would treat that $90, that excess over the par value, as paid in capital or additional paid in capital. They call it APIC for short, but we'll get into that in a later discussion. Then another component of owner's equity is retained earnings. And retained earnings is pretty much self-explanatory. It's your current earnings plus your prior earnings from prior accounting periods, prior years. So it's a retention of all of your earnings. All of the income that your company has made up until now that you haven't paid out in the form of dividends or capital distributions. And then last, you have your treasury stock, and that's a special type of owner's equity account because it is opposite of its normal account balance. So in other words, it's called what is something known as a contra asset, a contra equity account rather. So basically, treasury stock is a company buying back its shares of stock that it previously issued to shareholders. So basically, it's just the company buying back its own stock. That's basically what treasury stock is. So owner's equity, as we stated before, is what's left over after you pay all of the bills. So now we're going to have something at the end of every lesson called problem time, where we'll go over, look, I'm tongue tied, where we will go over a couple of questions to test your knowledge of what was discussed in the lesson. So question 1 would be, which statement regarding the balance sheet formula is correct? A, the balance sheet formula is equivalent to gains equals liabilities plus equity. B, The balance sheet formula is equivalent to assets equals liabilities plus long-term debt. C, the balance sheet formula is equivalent to assets equals liabilities plus equity. D, the balance sheet formula is equivalent to assets equals liabilities plus net income. Now, I put a side note under this question. When solving multiple choice questions, always eliminate the obvious wrong answers to increase your odds of answering the question correctly. So if you know something is the obvious wrong answer, just knock it off. Just exit out and move on to the next one, because it's going to increase your odds of answering the question correctly. So we know that gains, we never talked about gains equals liabilities plus owner's equity. That is not the balance sheet formula. We could X that out. Let's move on to answer B. Answer B is assets equals liabilities plus long-term debt. We know that that's incorrect because long-term debt is a component of liabilities. So that's the same thing as saying assets equals liabilities plus liabilities. So we know that that's incorrect, so we can X that out. So we'll move on to D. The balance sheet formula is equivalent to assets equals liabilities plus net income. No, we didn't discuss that. We discussed that assets is equal to liabilities plus owner's equity, or simply put equities, which is C. And there you see the balance sheet formula is assets equals liabilities plus owner's equity, or simply put equity. Question 2. What is the correct formula for the balance sheet equation? A, current assets equals current liabilities plus owner's equity. B, assets equals current liabilities plus owner's equity. C, assets equals liabilities plus retained earnings. Or D, assets equals liabilities plus owner's equity. And we know by going over the balance sheet equation several times that the answer to this question would be D, assets equals liabilities plus owner's equity. Remember that $100 in assets, it equals the liabilities of 40 plus, the liabilities of 60 plus the owner's equity of 40. The right side of the equal sign is always equivalent to the left side of the equal sign. There you go. Again, assets equals liabilities plus owner's equity, D. In the next video lesson, which is lesson number 2, we will be covering the current asset classification of balance sheet items. If you like my work, ladies and gentlemen, please hit the like button on this video. Please subscribe to this channel. Please share this video on all of your social media. And please sign up to become a Patreon member to enjoy exclusive benefits. May God bless you, and see you in the next video.